Hello and welcome. Today we'll analyze market structure, and I'll reveal a low-risk, high-reward swing trading strategy you could apply on any market, forex, stocks or crypto. So if you could, like, subscribe to the channel and stick around for the full video. The principles governing price movement are the same on all time frames. Price moves as a function of supply and demand. It moves between areas of previous supply/demand imbalance, which are defined as support or resistance. Price movement between swing highs and lows will form into trends, either as an uptrend, downtrend, or a sideways trend, trading range. An uptrend comprises a repeating sequence of 1. An upward extension, 2. A swing high, 3. A downward pullback, 4. A swing low. This is demonstrated in this chart, where you'll also notice a few other key observations. The price extensions are longer than the pullbacks. Extensions will break above previous swing high, reaching new price highs for that trend. Pullbacks will not break below previous swing lows. Hello and welcome. Today we'll analyze market structure, and I'll reveal a low-risk, high-reward swing trading strategy you could apply on any market, forex, stocks or crypto. So if you could, like, subscribe to the channel and stick around for the full video. The principles governing price movement are the same on all time frames. Price moves as a function of supply and demand. It moves between areas of previous supply/demand imbalance, which are defined as support or resistance. Price movement between swing highs and lows will form into trends, either as an uptrend, downtrend, or a sideways trend, trading range. An uptrend comprises a repeating sequence of 1. An upward extension, 2. A swing high, 3. A downward pullback, 4. A swing low. This is demonstrated in this chart, where you'll also notice a few other key observations. The price extensions are longer than the pullbacks. Extensions will break above previous swing high, reaching new price highs for that trend. Pullbacks will not break below previous swing lows. This results in a series of higher swing highs and higher swing lows. An uptrend ends when price breaks the swing low, which leads to the highest swing high of the trend. Failure to break the swing low that leads to the highest high could simply indicate a complex pullback rather than a reversal. Remember this part because we'll use it later in our trading strategy. When I'm analyzing an uptrend, I prefer to do it from the perspective of supply and demand and traders' decisions. I've talked about this concept in this video. An area of support has formed as traders have determined that the swing low is good value. New long positions are established and bullish sentiment results in rising prices. An upwards extension develops due to bullish pressure overcoming bearish pressure. Traders are willing to continue buying at higher prices, pushing price to new highs. At some point, short-term longs will take profits and more shorts are attracted to the market. This increase in bearish pressure will form an area of trend resistance, forming as a swing high. The fall below the swing high attracts more bearish order flow, as more longs will take profits and more shorts are attracted to the market. But this is not necessarily an indication of a trend reversal. Lower prices that occur are unable to break the previous swing low. Rather, these lower prices attract more buying. A new area of trend support forms as a higher swing low. Bullish sentiment again leads to a rally from this swing low area, and the process repeats. Interestingly, the bullish pressure within an uptrend is not just from new buying decisions. Remember, each transaction involves both a buy and a sell. Bullish pressure within an uptrend also comes from shorts, who tried to pick the reversal, exiting out of their losing positions. A significant portion of the bullish pressure within an uptrend is the losing traders exiting their position via a buy order. In many respects, the uptrend is fueled by the losers on the bearish side. A downtrend comprises a repeating sequence of 1. A downward extension, 2. A swing low, 3. An upward pullback, 4. A swing high. During a downtrend, you'll also notice a few other key observations. The price extensions are longer than the pullbacks. Extensions will break below previous swing lows, reaching new price lows for that trend. Pullbacks will not break above previous swing highs. This results in a series of lower swing lows and lower swing highs. A downtrend ends when price breaks the swing high, which leads to the lowest swing low of the trend. Failure to break the swing high that leads to the lowest swing low could simply indicate a complex pullback rather than a reversal. Again, we'll include this concept in our trading strategy. This might sound basic or not important, but determining a trend is one of the most important part in trading. And here's the supply and demand perspective in a downtrend. An area of trend resistance has formed as traders determined that the swing high is overvalued. New short positions are established and bearish sentiment results in falling prices. A downwards extension develops as traders are willing to continue selling at lower prices, pushing price to new lows. At some point, short-term shorts will take profits, and new longs will be attracted to the market by lower prices. This increase in bullish pressure will form an area of trend support, a swing low. The rally from the swing low attracts more bullish order flow, as more shorts will take profits and more longs are attracted to the market. Higher prices attract more selling. Sentiment changes again to bearish as traders who went long cover their position, recognizing that the upwards price swing is simply a pullback and not a reversal. A new area of trend resistance forms as a lower swing high. Bearish sentiment again leads to price falling below this swing high and the process repeats. Also remember that the bearish pressure within a downtrend is not just from new selling decisions. Much of the bearish pressure within a downtrend comes from longs, who tried to pick the reversal, exiting out of their losing positions via a sell order. Now that we covered the trend aspect, let's see how we can profit from this. I prefer the daily chart for this technique, but the H4 and H1 time frames are also effective. So, this is a swing trading strategy. Now, when a market closes up for consecutive days, traders get excited. They start speculating that the market cannot continue its upward streak. Somehow, we are wired to think that what goes up must come down, and vice versa. This is why consecutive up/down days form the basis of many stock scans. So, we will explore a price action trading strategy based on the same idea of consecutive up/down days. But we will focus on the market context of such consecutive up/down days. Fading consecutive up/down days often means going against the market trend in momentum. It is a somewhat dangerous strategy, but it does not have to be. In our low-risk variation, we focus on fading consecutive up/down days that go against the market structure of swings. That's why I explained the market structure of uptrends and downtrends. We'll use that knowledge to find low-risk, high-reward trades. Here's the long entry criteria after consecutive down days. 1. 4 or more consecutive down days, close below open. 2. If the market has not breached the last swing low in the market structure, buy above the next bullish bar if there is an increase in volume. Basically, it's a trend continuation pullback strategy. You need to trade the market structure of an uptrend to find 4 or more consecutive down days, and to trade in the direction of the main trend if the market has not broken the last swing low in the market structure. Here's the short entry criteria after consecutive up days. 1. 4 or more consecutive up days, close above open. 2. If the market has not breached the last swing high in the market structure, sell a tick below the next bearish bar if there's an increase in volume. Again, you trade the market structure of a downtrend. You first need to define the downtrend and identify the major swing highs and lows to find 4 or more consecutive up days and to trade in the direction of the main trend if the market has not broken the last swing high in the market structure. This is a daily chart of AMD1. These 5 consecutive down days caught our attention. Is this the beginning of a powerful downtrend? Or it's just a correction in an uptrend? 2. The 5-bar thrust did not reach the previous swing low, hinting that the market was in the second scenario, a correction in an uptrend. 3. This bullish bar was our setup bar. Observe this slight increase in volume. Ideally, I would want the volume to be even higher to show the dominance of the bulls. We bought the next day, a tick above it. The stop loss is always below the setup bar. You can take profits in several ways. My preference is to exit 50% of my position at the next swing high. And then I put my stop to break even and continue to trail my stop if the price breaks that swing high. With this approach you can catch some giant moves. If the distance between your entry and the next swing high is too big or too small, be conservative and close a part of your trade when you reach a 2:1 reward to risk ratio. Here's the ideal setup. This is a daily chart of NVIDIA 1. First we identify the market structure. Uptrend, higher highs and higher lows. Observe these 4 consecutive down days. 2. The 4-bar thrust did not break below the previous swing low, which hints that this aggressive down move it's just a correction in an uptrend. 3. This bullish bar was the setup bar. I prefer the setup bar to be a large bull candle. If I see a low spread candlestick, I tend to ignore the setup. Look right here. Another potential setup for consecutive bearish days. But look at the bullish bar. It's a low spread one, with wicks at both ends, and with low volume below. So, remember, the bullish bar, the setup bar, must show momentum. This candle was quite big, revealing the presence of bulls. And observe this increase in volume. The highest volume in the past 20 days. In YCAF terms, this was a large effort, large result day. We bought the next day, at the open, as this was the ideal setup. This is the aggressive entry. You don't wait for the high of the bullish candle to be taken out, you enter right at the open. The stop loss is below the bullish setup bar. Again, exit 50% of your position at the next swing high. And then move your stop to break even and, hopefully, let the uptrend continue its course. You can trade this swing trading setup on the short side. Here's PayPal on the H4 timeframe 1. First, we identify the market structure. We have a clear downtrend with lower lows and lower highs. The market swings are not so obvious as we had several gaps. Observe these 5 consecutive up days too. The 5-bar thrust did not break above the previous swing high 3. This bearish bar was the setup bar. This is a relatively large candle with a wick on top, showing a clear rejection, bearish momentum. We also had an increase in volume. Not the ideal setup, we had another bull day with higher volume, but an increase in volume on a bar that resembles a pin bar was still a good probability trade. We enter short at the next H4 candle. The stop loss above the bearish setup bar, and we target the next swing low. And look here, consecutive up days. But this was no longer a valid setup. Remember the market structure condition. The price broke the swing high, so this was no longer a valid downtrend. Using the market structure to filter consecutive up/down days is a simple method to make sure that we take only the low-risk setups. And stick with the higher time frames if you decide to backtest this strategy. There will be fewer trading setups. However, it is a worthwhile sacrifice for better trading quality. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.